like 90% of that account value so that you don't get screwed. Because if you're insuring a bunch of people's $1,000 accounts and most of them are going to blow it to zero, right? That's where you'd have to really get into the math side of it. And I'm not telling you that there's not something there, because there may be ways to like basically play the broker. That's what the broker does with margin calls. You're kind of describing like margin calls is where they evaluate your trading and all this and that. So something to think about. I'm not saying that there's nothing there, but you really have to be careful if you're going to insure traders or think about that. There's probably a whole bunch of like legalities to that, but then also there's a whole bunch of risk to trying to insure. Like you're almost being a prop firm and a broker at the same time, because you're trying to evaluate people's trading behaviors. Any insurance company is going to evaluate their asset they're insuring. So you'd have to evaluate. You're pretty much talking about becoming a prop firm or a broker.
Yeah, I'm not sure really why or how that would work, to be quite honest. And I'm not meaning to, or like Nick said, I'm not trying to shoot down the idea, but
yeah,
with things like, let's take car insurance, for example. That's not really based on the skill of the driver. That's just an accident. Anyone can get into an accident, regardless of how good or bad you are. Someone, Nick could get into a car, God forbid, obviously. Nick could, in theory, get into a car accident tomorrow, or I could. It's not a case of a trader's profitable or not profitable. It's a very different concept in my view.
Yeah.
So yeah, I'm not sure about that idea.
Well, and if you're looking at like a car or a house, there's like some amount of value that whereas with you're insuring someone's trading account, the expected value of that is for it to lose value substantially, like quickly, like $1,000 likely going to zero for most traders, unfortunately. So it's just the reality of it. It's like trying to insure somebody whose crash rate in their car is 90% of the time they get into a crash. So it's really a challenging. It's an interesting concept, and there might be some way. It may not be like, oh, I'm going to protect the whole amount of your account, but maybe you like talk about like doing some partial rebates, or maybe you do the other way around, which is what the prop firms do, where they say if you do really well and you're the exception, we'll find ways to compensate you, but they're really getting paid out by the 90% of people who are losing money. So prop firms have done it the right way, I think, by doing the opposite. They've bet against the average trader, which, call it predatory, call it just a business, I don't know, but that's something to think about too. Prop firms are making a ton of money by doing the exact opposite. They're not insuring you. They're basically collecting a premium from you. They're selling the insurance to you rather than, the other way around. Anyways, James, we got to go. We got Chris Pulver up next, and we've kept him waiting. So thanks for doing the questions. That was fun, just doing a couple with you, and maybe we can do more of that in the future. I enjoyed that.
Yeah, no, I enjoyed this. It was good. Do you mind if I upload this onto my channel just before we go?
Yeah, go for it.
This little segment. Cool.
I think it's
all right.
Segment.
Well, guys, have a good one. I appreciate you all being here. Enjoy your weekends. I'll speak to you all very soon. Thanks, Nick.
Sounds good. And just a quick plug for James also. His channel is FOREX James. You can find him on YouTube if you want to find him there and maybe see that clip later today. All right, up next, we got Chris Pulver. See you, James.
Hey, everybody. Thanks for tuning into today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
What's happening, everybody? Happy Friday. What's happening? What's new? Well, markets are up again today, kind of. We came up and filled this gap. This is the gap from April 2nd. I had this drawn on the charts this week. There was certainly a head fake with the GDP numbers on Wednesday when the market dumped about 2.2% and decided, that was just a little spot to buy the dip. So we came back up and filled this gap. We do have a gap down here. We do have a gap as well in here. But hey, look, if the market's going to keep humming along until this structure breaks, maybe a bit more aggressive on a trend line, I'd say we just let the melt up continue, shall we? If it's going to melt up. A couple things I want to bring your attention to. I would say I don't get super excited about where we are at. I do have a big question mark. I pulled this yesterday from Bloomberg, which I thought was interesting. Widest gap in sell side S&P 5 targets this century, which means from the year 2000 to now, nobody knows where the market's going to go, right? The gap between the highest and lowest year-end price targets. So forecasts, some say 7,000 plus, some say we're going to be down. Doesn't matter. Point is, it's the widest in history since, well, I guess the widest of the century. So for 24 years, where you could argue like 1990 to now is like the modern market. The left tail, right tail, the distribution is so wide right now. So what does this really mean? Nobody knows. Nobody knows where the market's going to go this year. I don't either. And it's okay to say that. For anybody that claims to know where the thing is going, they're full of crap. Like, look, I'd say the easiest way to make money this year is if we're pleasantly surprised to the upside, there's ways to make money, right? Like that's easy money. Okay. I have been grinding all year, money on hedges and protecting, money on hedges and protecting, having the courage to sell premium during a nasty downturn when the VIX was spiking up to 45, 55, and 60 when it peaked, and then riding some of those out for those 30 to 45 day windows, which a lot of these trades have been closed up for profit. I think last week I closed up over 130 trades for profit. This week's been pretty active as well. I did some rolls. I did some pruning. I did take some profit. I closed another one out for Oracle. See if that was this page. Yep. So Oracle was another winner. That was a ratio spread that came back up. It was $1.31. Closed it for 91, just taking the winner because it was coming back to my assignment price. HIMS has actually been a trade that took off a little bit. So give me my price. What are you guys doing here? HIMS is at 38.96. I don't want to get super greedy here, but I think that HIMS, let me see if I can grab a profit chunk here. I might go. Gonna leave a small credit out for the SPX trade. HIMS and HERS. So there's earnings on May 5th. My expiration's out to May 16th. I actually did a diagonal spread. So here's what the trade looks like. I did a ratio spread on HIMS as well as a diagonal spread. Where is it? HIMS. Here's a ratio spread. It's up about 51% of max credit right now. I wouldn't mind owning shares of it. And then I also have some diagonal spreads. So I have a diagonal spread, which is currently up around $500. And it could get called away at 37 by May 16th. This is taking into account earnings. Earnings are the 5th. So this is going to be next week after the bell. So do I have to do anything on this? Not necessarily. What I could be doing is maybe looking to roll this out. I don't want to be super greedy, but there's a chance that if price comes back down below $37 and I don't get it called away, and I guess if I wanted to not worry about this one, I can just take the profit now. So what's the max profit here? This is $22 and is trading for, is that even possible? I don't think they're going to let me close out for more than that. So 37 minus 15 is 22, and it's showing like a 22.80. That's got to be too wide. There's no way they're going to let me close for that. So what did I take this trade for? I'm just going to do some double checking on the debit side. All right, so the diagonal spread break-even price is $32.95. If it gets called away, yeah, about $405 would be my max profit on this one. So let me see here. I don't know if they're going to let me take a trade that is better than this, but I've got a bid price at $22.05. Let me try $22.50. $22.74. Well, shit, that was pretty nice. So 22.74 minus 17.95. Yeah, $490. Yippee skippy. So that was pretty sweet. Well, I guess I'm going to close down some HIMS for some profit. That's before earnings. So I'll take that trade off. not have to worry about it. So the diagonal spread, which is a 15 and 37, do some updates here. So this one, this is a ratio spread. There we go. So the 37.15 close. Might as well try to get it really generous. 22.80. 22.80 just got filled. Very nice. Oh, that's a pleasant surprise. 15 by 37. There we go. And this one's a ratio spread because I don't mind owning the shares, but the diagonal spread is closing out for some nice profits. So this will be close 22.90, 22.85, filled. All right, just gonna do some management on these. Just give me a couple of minutes. All right. 22.85. Very good. This had to be in my diagonal spread peak. There's otherwise I shouldn't be able to close it out for more than $22, but I mean I'm gonna take it, that's for sure. 37.15. Oops. The ratio spread I'll keep open, but the diagonal spread I'm going to close out. Can I get more? Nope. 22. I'll stick to that 22.85. That's still pretty good. Good. Let's give me an extra 85 cents, which I will definitely take. So diagonal spread, close, 22.85, closing down. Okay, 22.89, even a better fill. No complaints. Okay. Closing. Good. All right, so this is a nice little win. So 17.95, closing for 22.85. About 490 bucks on that trade. Still going. Closing. So I'll update this in Pulver. So Pulver alerts, close it. I mean, I'm getting 85 cents more than max. It doesn't bring earnings into play, so I'm limiting a lot of that risk, which I'm totally fine with. That's a ratio spread. That one's okay. I'm just going to hang on to that. This one ratio spread is fine. This one ratio spread is fine. This one's cash account. This one I have both. So there's my call, my call. So my diagonal spread I want to close 22. See if they're going to be generous enough to still give me my 22.85. Yes, I will take it. Okay, and new client account that just came in this week. All right, so closing down some hymns. Diagonal spread close. Ratio still open. Ratio still open. Diagonal spread close, 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 close. So how many trades was that? That was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 trades. Not bad. $490. So it was $5,000. 490 times 10 accounts, $4,900 on HIMS. That trade was open not that long, about 30 days. Not too shabby. Yesterday I talked about Tesla. I did roll Tesla out. Couple decisions on that one. Let me double check my butterfly spread for SPX really quickly. How's this not filling? Showing some profit. All right, let's see if we can get up there. I'm gonna leave this here at, I'll go 45. Okay, so let's go to Tesla. I've got to take this trade off really quickly. So HIMS is done. So one part of it, I'm gonna keep the ratio spread on HIMS, but I'm closing out the diagonal spread. There it is. 25 by 20. Closing for 22.85 credit. Close both legs. Net profit would be $4.90 per contract. Very nice. Checking out okay, very good. Tesla. So I made a decision on Tesla. We're trading at 282. I said if it was above $300, I was going to roll it, but here's what I decided to do instead. I don't mind having 100 shares, and I took the income trade out of this May 16th. This is a 111 trade. So I bought the put at 255, sold the 250, sold the 245. I took profit on that. I did a big update in my Pulver alerts yesterday on Tesla. So I have 100 shares. I have taken profit already. I did take this other chunk of shares that I'm currently sitting on. I had a 257.50 covered call for this Friday, which is today, and it's going to get called away. Yesterday, I decided to roll it out to next Friday, which is 5/9 expiration, and I rolled it out for $255 per contract. Okay, so that gives me 100 shares with a break even of 242.05. So I now have, I mean, this is, I'm speaking for all accounts. I have 500 shares in total, but just per account breakdown, I have a break even of 242.05 with a covered call at 257.50. So if it stays above 257.50 by next Friday, I make 1545 times 500. I'm making 77.25 on Tesla. Now, the reason I wanted to consider, okay, do I just keep this one open for income, or do I potentially, run the risk of getting this one assigned? So what I decided to do was close this one for a win. This one I pulled in $3.25 credit, and I closed it down for, let me see what it was. Got it written down here somewhere. Tesla 284 down to 85 cents. So it was a little high there. So 284 credit, and I closed it for $1.85 debit. Okay, so $199. Now I did that on 5 accounts. So there's $1,000 there with no assignment risk. So income, no assignment risk. Now I'm just going to focus on how aggressive can I keep rolling some calls. I mean, look, if Tesla comes down, it's okay. My break even's 242. I'll keep lowering the cost basis. If Tesla goes up, I'm going to keep rolling calls. I'll roll it week to week to week, and I'll hopefully get like $1, $2, $3 per week. And even if I never like catch up with the stock, I'm still just going to roll this thing out and try to increase its bottom line. Every time I roll this, let's say I get $1 for a roll, it adds up to about $500 a week. So it's not bad. But if price comes down and I have to contend with, price is falling and the premiums to go up, which is a good thing. I'm just going to have to make sure that I'm lowering my cost basis. Right. I just saw some news this week, like the auto driving on Tesla is supposedly like 10 times better than any other competitor right now. I think the worst part of Tesla was kind of priced in. I know Musk is now heading back to Tesla, or at least leaving Doge. I think they're still in the looks for somebody to like kind of take the helm at Tesla, be CEO. I don't know if he's like officially taking a leave of absence or if he's just dedicating his time elsewhere. Nevertheless, markets are up. It's funny how Tesla. I mean, S&P has gained for the last couple of weeks. We're back to the 200 moving average and a little bit higher. Mag 7 did pretty well this week. Tesla was just so beat up. It's like, we'll rip right there. So that's where Tesla was making the big run. I think if we just stay here and chop around, is it possible that we break this high? If we break this high, I mean, the nice thing is it's open space. But just be aware that this could be a range trade. And, could we go lower and then have a pattern on the right-hand side of this? All the above could happen. But if it goes higher, I'm just going to keep rolling, and not to mention a little Biscuit song, but I'm just going to keep rolling covered calls. So this is now a 5.9. Roll to 5.9 for 255 credit, and I will keep just tallying up the income. I'm not going to get super greedy. I would say by the time the Fed's going to cut in June, I'm really curious what the market's going to be doing. My initial thought when I first jumped on today's session was this. Okay, look at this chart. This is the effective funds rate. Okay, the way this times with the market, I am a bit concerned that every time we've seen major cut cycles from the Fed, the markets have never responded very favorably. So if we're looking at this year, 2025, when they start cutting in June, possibly in July, possibly again in October, and maybe by December, there's 3 or 4 cuts that are planned out based on the CME Fed Watch tool. I don't know how this is going to be good for the stock market. I know that everyone thinks like, well, the Fed's going to cut, that should be better. It might not be. Like all the good might be priced in. Okay. This is yet another thing that would make me believe that it's going to be difficult for the market to get to all-time highs, or at least have big momentum above the all-time highs. Right. So if you overlay, if I take this chart, let me use a blank workspace here. Let's go blank. And 10-year yields are freaking up. This is another reason the Fed probably doesn't want to cut too aggressively, is because yields are not cooperating. I mean, yields are up 3+%. Basis points wise, they're up about 16 basis points. Anyway, Fed funds rate. Okay, now overlay the SPX. We'll go new pane. Okay, so I'd have to, let me see if I can go to like a monthly chart. There, it should be a little bit easier to see this now. Take a look and see how this has responded to these major Fed cuts. Fed cut cycle, market was down. Fed cut cycle, market was down. Fed cut cycle, market was down. We did cut 100 basis points. Now, I understand that, but we were way up here at like, 4 to 5% cutting down to near zero. 4% cutting down to near zero. 2.5% cutting down to near zero. I know that we're not necessarily going all the way back down to zero. Maybe it's different this time. I just don't know how this going back, 20 plus years has ever been a good sign for the market. So, Trump urging every single day, Fed needs to cut rates. Fed needs to cut rates. Do they? Because history would show that it's probably not the best thing for the stock market. Because usually when the Fed is cutting rates, it's into economic weakness. It's into an economic slowdown. So I don't know. I mean, I have my concerns, but I think if they stay, true to May, they don't do anything next week. This is a 98.7% chance they just do nothing next week. I don't know if there's going to be pressure. All of a sudden, it's like the Fed's, they're too late. They're Mr. Slow or whatever the hell Trump called them. I don't know. It was obviously super, super good etiquette to basically call the Fed chair a loser. But anyway, I think Powell's done as good as any. Whether you agree with the Fed or not, nobody's going to agree with the Fed. They're always going to be wrong. They're always going to be reactionary. But their job is to provide stability and liquidity, and they do. And coming into June, right now there is a chance of a pause. Right? This is all kind of shifted, which I think is really interesting. Here's probabilities. So they're looking at now shifting a May to June pause. This changed this week because it was a June, July, September, October, or either October, December cut this year for 4 cuts in 2025. This looks like a pause for May and June. I mean, why? I don't know. But maybe because we have tariff uncertainty hitting July onwards. But I would be buckled up for maybe a wild second half of the year. If the Fed does start to cut, I think that correlation is something we need to be aware of. So just throwing it out there, like big picture. Okay. The market doesn't typically respond well to, let me get rid of this one here. The market doesn't typically go well with like aggressive cutting cycles. Usually we don't see that show up and be, super bullish. So anyway, time will tell. But here we are today. Just kind of hanging out. I'm thinking if there's any upside here, just got some real levels. The market makers may be able to defend this level here. Let me see if I can just get out of this butterfly spread. I'm still showing a small profit. So you can get out of here for like 35 cents. Fudge. All right, I'm just going to try to get break even then. All right, break even. I'm not taking a loss today. I've had too good of a week. I'm not forcing any trades. Give me 1 second. All right, let's get back to it. So I'm taking a break even on the SPX trade. Let's put this back. Let's go top down. Thanks for letting me, prune the account for a little bit. Close out Oracle for winter. So far for the week, again, active week, active trading per usual. SPX wise, we've pulled back into this 200 moving average. Okay. This is where I mentioned last week, lots of resistance. I don't know what's going to turn the corner here. We've got a measured move towards symmetry. This would be your low to high swing, higher low to higher high. We're almost right there. We've got the March pullback levels. This could be like the perfect little resistance zone for the market to. Look, I'm not saying the market has to go down. Okay, not all the way, but I would say, would anyone be surprised with this recovery? We just have a swing. We match that symmetry that we pull back into this area, and this kind of big box would be like no man's land. Right in here, it's like the bulls and bears can scramble, fight, claw it all out, and market doesn't really go anywhere. I wouldn't be terribly surprised to see between about 5,500, 5,700. There's just a big range. We don't necessarily justify going higher. We don't really break down and go lower. Economic data so far is okay, despite what we had on Wednesday, which is a big, hiccup in negative GDP print. It's better than what the Atlanta Fed forecasted at like negative 2.5 GDP. It was negative 0.3. But again, you go into like next quarter, do we print another negative GDP? Are we technically in that recession with negative GDP? It's 2 quarters in a row, maybe. Looks like the Fed, which I thought that was interesting, to just change. They pushed their rate cuts back. So instead of cutting in June like expected, now it looks like maybe July is going to be that first cut. That's when the tariff window opens back up, and we're going to see, who lined up and negotiated with the U.S., who didn't. We're going to see what type of creative jawboning Trump and co are going to deliver over these next few weeks. But I don't think strong arm the Fed's going to work. So we'll see how it all plays out. But I just think there's a lot of resistance ahead. If you've got profits, it's good to be protecting. It's good to be moving stop losses. Worst case scenarios, you get stopped out for profit. If the market surprises us with more melting up, I don't think this is a broad market. I really don't. Market breadth is still quite low. Here's your stocks above the 50-day. So about 40.55% of stocks are above the 50-day, and then above the 200-day. We're still sitting in a bear market, everybody. Whether you realize it or not, only about 35.58% of stocks are above the 200-day moving average. So that means 65% of stocks are technically in a sell zone. That's not a good thing. So we're not there yet. You know, like this is not a broad market rally. What has happened is this has been low volume, low market breadth, low participation, probably carried by mags, to be honest. Mags was beat up and probably overdone. So I think you had, strong opportunities to, buy this low and see the timing of like the market low on April 9th, as well as the participation of, beat up Mag 7. Tech looked okay. Tech was beat up pretty aggressively. That's a fast rotation. We've seen this come back around 23%. This actually has been better than the S&P. So Mags has done better than the S&P in this little recovery. But granted, it was also down a lot worse than the S&P. So you're just getting slightly more beta to that, right? So this was down 33%, while the index was down about 21%. And this clawback in the S&P about 15% has been up around about 23% on Mags. But again, you can see the resistance. It's right in here. This area between like now at the 200 or this March pullback high, I would say between this area, or even this outer trend line, if any of this sticks to force some resistance, we're probably going to have, if Mags drops again, the market's going to go with it, So anyway, something to watch, something to help with timing. If we get another opportunity to, buy based on market breadth being beat up, I'm probably going to take some stabs at those. If we might be at some equal lows, we might be at some fresh lows. But S&P, just trying to get everyone to acknowledge we've got some resistance. That's all it is. Right? So we'll see where the indexes kind of top out here. Same thing on NDX, coming back to the March level. This is my measured move. So low to high, higher low to higher high, measured move around 20,300. Qs, do the same thing as a SPY, can measure this all out. I just measured out SPX and NDX, but same idea. Dow's doing a better job. I mean, Dow actually came back this last couple of weeks. We're just pushing up in that 200 moving average. We did officially clear on the Dow. We got back above the April 9th candle. This was like kind of the lagging index here. So we're back above the April 9th candle. Is it able to get up into the 200 moving average? Maybe. Maybe this is just a big chop zone. Okay. And again, think of this from the perspective of where is the market going to put the most pain on traders? The most pain on traders right now would be it keeps going up, keeps going up, keeps going up, keeps going up, makes everyone think that it's like, this is a buy. This is a buy. I think that spot right there could be the ultimate bull trap where the market at least pauses, pulls back. We've got gap fills. We got plenty of levels to go back down and kind of, find some swings. I'm just wondering what the catalyst is going to be. Earnings season, Mag 7 is in. We're going to have some more earnings next week, but it's like the big ones are in. Amazon was decent. Apple was decent. Meta was great. Microsoft was great. Tesla was the exact opposite, but I mean, we still have some earnings season that's sprinkled in, but the big ones are I mean, we saw consistent earnings and solid growth. CapEx spending is still alive and well. I mean, Google, same thing. Like all Mag 7 stocks did pretty well. So do we get up into some bull trap territory? Possibly. How about the IWM trading at 199? I mean, heck, I might get this one called away. IWM, I've got a covered call at 200. IWM here. So I've got 400 shares all covered at 200, and these are out to June. I mean, I don't really want to roll it out. I want to see how this kind of plays. If I get an extra, $1,200 out of that, that's fine. If it gets called away, it gets called away. But I'm trying to put a lot of my kind of assumptions. Like if I'm going to be bullish, I think the market has runway like through the month of May into probably late June. If the Fed, I mean, maybe there's a reaction in June because the Fed would surprise the market by like, hey, I thought you guys were cutting in June and now they're not. If they pause, I don't know if the market's going to like that or not. If they start cutting in July, is it going to be like with more tariff drama? So I think there's still a lot of uncertainty. I just think that July onward, just be careful. Okay, but catching up a little bit, we'll see if we get a bottoming pattern here in the Russell. VIX is down to some fresh lows as we're just kind of carving out slightly higher highs. No big deal. The move index for bond volatility. So let's see if bonds have been doing anything. They should be going down. Yep. So TLT is going down, and that's why you have the US 10-year yield going up. And this is one of my big reasons for thinking that the Fed is not going to cut. And if they do cut, this is, and I've had this conversation many times the last couple months with mortgage bankers, and that is, this reaction has never happened. Fed cut rates, markets, bond yields react the exact opposite. So going into this window, if we look at a pause in May, pause in June, rate cuts in July, are we going to see yields higher by the time we roll into that July rate cut decision? Maybe. Do we see yields just going sideways where it's just back and forth? I mean, this is the break. Like the bond market, the basis trade, liquidity broke for about a week. And I don't think it's immediately repaired. So I think in the background, there's probably the Fed working, with the biggest liquidity providers in the world to, kind of settle things down. But I'm a little cautious thinking that just because the Fed's going to cut means it's a good thing for the stock market. I don't think that it is. I don't think that cutting rates is a good thing for the yields either. So things can get a whole lot more interesting with like this soft data, hard data concept. Today's non-farm was okay, but did everyone notice what happened to the revisions? Non-farm was decent, right? 138 forecast. It came in 177. Unemployment rate stayed at 4.2. But these revisions were pretty bad. Revision from 228 down to 185. Revision from 209 down to 170. So what does that look like next month? Is 177 revised lower, right? I mean, maybe these are all just false number. I don't know. So we'll find out. Cautiously bullish. That's my plan. Okay. All right. Let's go dollar index. Dollar index, is anybody starting to short the dollar already? I would be waiting. Personally, I'd still be waiting for like a 101 or a 102 handle. I'd like to see if this is kind of slowly work its way into some more attractive, kind of perfect technical levels. I don't mind waiting for kind of a perfect trade. If I'm right, I've got defined risk. It's a low risk, high reward type trade because we can get back to symmetry or go lower. If I'm wrong and I don't see confirmation, then I'm not going to force a sell trade. So I wouldn't force a sell trade if I don't see one. Oil, we did come down and stab those lows. We're bouncing off a little bit. I'm going to keep a close eye on this one. I've got that CL trade running to June. UNG starting to make a nice little run. This is a diagonal spread that I'm still working with. This one I don't think I put in a call side yet, but I may. I need to write that one down. So UNG. And I just saw a note here on my broker platform for Baidu. Yeah, it's probably another one to take some good profit on. So the wide bull puts, let's see. Those are fine. That's fine. Covered call, that's fine. We're trading at what? $91. Covered call's May 16th. I'll let that one just marinate. It's the wide bull puts, the 80 by 50 up $250. I might just close these down. Yeah, I think I'm going to close these down. This is up 63%. And it was such a, what's the probability here? June 20th. June 20th for China. June 20th, 80 by 50. I mean, that's a lot of risk to take in there. There's still about a 20% chance that it comes below that. I'm just going to take the profit. I'll take profit over the weekend. I think today's probably relatively calm. So coming to Monday, I'm going to put this on for Monday. A little bit more time decay. Close this out on Monday. should be the 80 by 50, and it's up around 62.7%. I'm going to see if that'll increase a little bit over the weekend and grab a few more bucks out of it. The other bull put spread, the 5 wide, I'll keep that one. So it's the wide bull put spread. Let me rename this one. So wide bull put spread. This one I'll rename. So wide. Oops, that's not, sorry, that's my bad. Rename would be bull put. So this one's wide. This one's wide. The 5 wide, I'm not that worried about. The 30 wide, I want to, kind of dump a little bit. That one's okay. Covered call. Yep. So this is the one I'm looking to close up. Looking to close up. The June 20th, 80 by 50. And then the 85 by 80. And then covered call. All right, I'll organize that. We did dollar. Let's keep going. Gold, 2263. I'd still like to see gold head a little bit lower. Again, thinking about the runway into the tariffs and the uncertainty, if gold just relinquishes a little bit of this crazy run, gold could get heated back up after a pullback into, I mean, we just hit the 21 moving average. It's still pretty aggressive to think like I'm going to buy the 21. I mean, obviously there could be a reaction there, but I think the 21 to 50, 21 here, 21 here. I mean, if this is a ridiculous bull market, then that might be your dip. Adding some more at the 21 period. That's an exponential moving average. I'd personally like to see the 50. I'd say area 1, I'm going to try to be patient here, and then area 2 is going to be at the 144 and the 200. If you're really anxious about gold, then maybe taking a stab at this with a tight stop and see if this responds off that level. That's understandable, but I'm not trading gold that short term. Same thing at gold futures. If we come back down into these levels, I'm looking at probably a 111 trade or 1111 trade on gold. Silver, still haven't broken the highs yet. I also need to come to grips with silver might just be a range trade, that it's not breaking highs or lows. So if silver comes back down, maybe there's some strong support around 29. I still like adding some more exposure there. Really well supported at 26. So I'll just be watching silver. If I can buy some more, add some more exposure, I will. This is still a position that longer term I want to see up into the 40s. Bitcoin breaking some highs. This might be a bit of a melt up into, 100K. We could possibly make a squeeze into the highs. Because this is squeezing a bit inefficiently, I don't think Bitcoin is necessarily going to break to like 120 to 130 without having some type of pullback. This is probably going to be some type of flat pattern, some type of accumulation pattern. So if you are near term Bitcoin, that's a good trade to just get out, right? Like you're coming up here to the highs. That's a good spot. If you were buying, this 75,000 past resistance becoming support, fantastic entry. It's still going up. And right now, you're up 30% on Bitcoin, which is pretty good. We come up to these highs, great. That right there as just a trade, not long-term hodling, just a trade. That low to that high is a great trade on Bitcoin. If you take profit there, I think there's an opportunity to come back down, revisit the lows again, and then start the process over. You trade Bitcoin in 2025. If it breaks and go higher, great. I'm happy with that too. But just in case we have a chance to accumulate, I'm going to look to be accumulating some Bitcoin. So IBIT, same thing. I've got covered calls in the 62 zone. They're not that far out. I think I'm out to May or June on those covered calls. IBIT. So my calls, May 16th, 62s. I'm up about 80% on those. I don't intend for this to get called away. I don't want it to get called away. This is an income trade. I will continue to still sell covered calls. But my 111s and income trades are looking pretty good. Covered calls, naked put combo. I did this. It's already up some profit, but obviously a lot more to go. This 111 looking for profit as well into June. So anyway, I mean, I've got plenty of trades. That's a lot of trades running on IBIT, plus some shares. Work through those. So I'm going to go Baidu, IBIT. Just want to do some organization in the portfolio. All right, MicroStrategy up to 396. They had earnings. Lo and behold, they missed earnings, but nobody cares because MicroStrategy doesn't trade like a tech software company anymore. They trade like Bitcoin. So Bitcoin's up. MicroStrategy pretty much has a moat. Hey, who cares if our business operation sucks? We have Bitcoin. So I think that's really interesting that you can have a failing tech company and a software company and still have your stock perform like one of the greatest performing assets in the last 10, 12 years. Not too bad. Coinbase hanging in there. Got out of these income trades. These are ratio spreads that did pretty well. Ethereum still waiting for the right-hand side of the trend line. Copper, what a mess. Copper is probably going to continue to be messy. There's a high, there's a low. Don't be surprised if we see some wedge trading in here, something like that where it's indecisive. All this crazy head spinning volatility, things just might slow down a little bit, and that's okay. Things might just slow down, and that's another thing traders have to be prepared for. Is it might not be just easy direction. We might hit this rough patch where it's like, okay, direction in February, pull back in March, direction March to April, rip all the way up to April. Did you know, by the way, that April being down double digits at one point? Let's go back to the SPX. Look at the monthly candle. Okay, April. Oh, geez, I got all this crap on my charts. Hang on. Blank. Okay, look at April for the month. So the month started right here. And at one point, the month was down 13.59%. Sorry to everybody that dumped their positions and got scared out of the market, because what did April do? Just fought back like crazy, ended up finishing the month about 1% lower. Just insane volatility. May is usually a pretty good month for stocks. So I guess if you could survive March and April, you're doing just fine, but it wasn't easy. And I also think that, this is going to be my argument. If we get back to all-time highs, I mean, what an incredibly self-induced, disruptive, like nonsensical bunch of crap that volatility was. Because what it showed is a tough agenda was completely thrown away. Like, we want to come in, we're going to, shrink the government. We're going to, cut $1 trillion in excess spending, corruption, blah, blah, blah. Sounds good on paper. We're going to create a trade war and tariffs. We're going to get the US back on top. We're going to onshore. All of it sounds good in theory. You can't run a government that way, apparently. And I think that's the sad reality is, like, governments are bloated, governments are inefficient, but don't break things, because that has a lot more. I think that has more dire consequences than, haircuts here, trims here. Problem is we just don't have like a bipartisan system really. So anyway, it doesn't matter. I'm saying, like, this is just that's a wild candle. But usually when you see a candle like that, I don't think that is a bullish sign to be like, well, there it is. You just survived that giant low. What I'd say instead is this wick probably means something as far as, like, if the bulls fail, I think this wick is going to get retested in some way, shape, or form. There's still a trend line here. There's some bear trap material, but I mean, pleasant surprise as we go to the upside. And I'm sitting here like, well, that was crazy. I can't believe we went to the upside and hit all-time highs. The other side of this is no man's land, and there's a lot of chop and there's a lot of indecision, and all the head spinning direction becomes quiet, right? All this down, up again just starts to settle down. And that is maybe what we're going to deal with here in the next maybe month or two. If I'm wrong and it goes higher, fine. Portfolio is tilted. I'll benefit from that, but this is still a trader's market, in my opinion. And I'll wait for my opportunities. Okay, so that's where we're at with those measure moves. We did silver, we did Bitcoin. Let's go to, I was on copper here. I think copper is still going to be a lot of noise. So high, low, maybe copper just kind of flakes out with some indecision. There's really good support on copper. It's just going to depend on if the, China, US can play nice together, because that would probably be a good thing for the global economy. Otherwise, copper is probably going to dip back down to the lows. Japanese yen coming back a little bit. maybe this is just a big range trade. Lows here, highs here. Maybe the Japanese yen comes back down. I'm not sure. Currency pairs have been a little bit messy on the FX side for Japanese yen. Today we have New Zealand and Aussie on top. We got the Swiss was up and then flat. We got the dollar weaker again. Yesterday was dollar strong and Japanese yen weak by a big way. They didn't cut rates or anything. Japanese yen is still 0.5%, right? So this would have been Wednesday to Thursday. Yeah, they still kept rates the same at 0.5, but something they said got the market to hate the Japanese yen for at least the day. All right, let's keep going. Let's see. German markets. Look at this. Jeez, Pete's, man. Talk about a freaking V bottom. You know, and I'll say, just because I'm looking at this chart, it's like, is it possible that the U.S. market does the exact same thing? I mean, the DAX is almost exactly where the whole thing started after just an incredible disruption. Is the U.S. market able to do the same thing? Maybe. Right? I mean, I'm saying it's like it would be kind of nonsensical because it just seems so disruptive to have that April volatility. But if the DAX can do it, you know, and the FTSE can do it, and all these other like non-US countries can do it, it's like, is the US going to do the same thing? Maybe. So, I mean, what did I do on this big dip? I just sold some puts on FEZ. That's it. Like, it's not a crazy trade. I just sold some puts. FTSE, I'm not trading, but we're doing the same thing here. It's like we're melting up. We're melting up. We're melting up. Argentina, a little stuck. I'd like to see this one dip a little bit more, but DAX has been good. Like anybody, you know, buying that 200 moving average. Here's the DAX. Anybody buying on the daily chart, that was your dip. This started off like, you know, I was noting early in the year, like all the non-US plays, like if you're invested in China, if you're in Europe, if you're in Latin America, like all these things were looking better. Well, you had a flush, you had a chance to buy, and there was your dip. So they're still performing well. They're still actually outperforming year to date the US. I just wonder, like, are there legs to this? You know, is this a broadening pattern that's gonna, you know, end up making some fresh highs but be a bull trap? I don't know. Maybe. If I'm wrong and this thing just goes up here and then consolidates, then maybe this is the time for the non-US plays to outperform. So good for old Germany. China, a little bit higher. Like yesterday was a good day on China. Brazil just hanging out above the 200 moving average. ILF hanging up above the 200 moving average. Mags, just like US markets, we have some resistance ahead. So it could be right at the 200 moving average. It could be the March pullback. It could be this 618 swing. But I'd be watching for some resistance here. If the mag starts to dip or drop and there's follow through, that's probably dragging the markets with it. Apple earnings, I'm watching. I've got see if price can get down below 203. Amazon earnings, we're sitting right in the middle. I should have just fudge, man. It's about a 60% chance to hit the expected move. I'm hoping there's no volatility for next week on this trade. I mean, I could just dump it. Let me see what I'm in for right now. So Amazon. So this trade is for earnings. It's down about 60%. Ugh. I mean, I could take the partial loss and just move on. Apple is a little bit better. But still not profitable. I had a nice win on Microsoft, a nice win on Meta, but Apple, Amazon didn't deliver with a big move. So still get out the next week. Let's see what we get. We're sitting right in the middle, so I don't love this. I don't love that we have to go either down or up. I mean, I think we can get there, but this is my break-even price really going into next week. Netflix. Still grinding higher. This is why I said don't call the top on Netflix. I'm glad that I didn't because we're just drifting higher. NVIDIA, I think there's room to hit the 200 moving average. I think a big tell for NVIDIA is if we get a rejection off that 200 moving average or if we can still climb above it. There's room to get into the 120s, 130 maybe. I've got a covered call and a collar trade in this one just in case. Tesla, I'm going to continue to roll for some income. Berkshire Hathaway just poked the highs. If this was better premium, I would sell this. If this was better premium, I would do like a call condor, which is a, buy a call, sell a call, sell a call, buy a put, buy a call, create a little profit trap. But if it melts up, that's a silly trade. I don't think the premiums are that great. Let me see. I'll actually price it out real quick. So Berkshire B. Earnings on this one, May 3rd. I'm sure their earnings are okay. I don't want to see that thing surge higher. So yeah, I'm not going to trade this in front of earnings. I'll stand aside, but maybe post earnings, I might look at a trade. Anyway, we'll see. Look at this. Bonds, just garbage. 1 to 3 year bonds, trash. Just getting beat up so badly. 7 to 10 year bonds, down. Like bonds are down, yields are up. 3 month, 2 year, ripping higher. Look at that. These bond yields are aggressive, man. Like that is a big, big, big rip. And this is again what I keep talking about this. Like I noted this on the chart, Liberation Day. We have not seen yields go back to that. The Fed cutting rates does not guarantee that the market's going to push these yields lower. Global yields are higher. It's hard to get the U.S. yields to go lower if across the board everything is up. So I think this is that big fiscal cliff, that big liquidity air pocket, that big like refi window that it's going to be tough. If everyone that took 5-year loans at near 0% during COVID, nobody's going to want to finance at 5, 6, 7, 8%. That makes things very like that is the poster child for this economic slowdown. I mean, on a positive note, we don't have like crazy high inflation right now, but yields are sticky, and we're not we're not sub 2% inflation anyway, but yields are still sticky and going up. So bonds had a rough day today. Currency wise, let me see some China here. So Alibaba, Baidu. I'm going to let this one sit over the weekend. FXI, KWeb, JD. I still have JD looking to get this one called away at 40. I could probably roll this one down. Let me check real quick. So I have the shares covered at 40. Naked put combo. Maybe not a bad trade either to close out. So some JD. That's further out than I'd like to be. So 27.25. I mean, I sold 3 puts, collected $5. They're up $300 right now. That wouldn't be a bad trade. I still have a covered call on some of the ownership. The 27.5 and 3. So 27.5 and 3. And then the 40 is a covered call. There we go. So wouldn't mind grabbing some income there. That'd be another $900 on JD. But I'd like to see if this can hold. If we hold these lows, I mean, maybe it's a range trade. I just don't want to see it breaking down below here and have those puts exposed. So I'm probably going to take those profits. All right, SEHD. This is dividends. This is growth. Clawing back in a good way. These aren't super volatile. I mean, it was earlier. I'm down a little bit, but if we come back to the lows again, honestly, if you want a cheap ETF way to expose yourself to some growth stocks, there's about 200 in this ETF here for growth stocks. Schwab dividends. This is similar to the Dow, but it's just way cheaper. Would you rather buy the QQQ? Would you rather buy the QQQ at 488 to have your top 100 tech stocks, or would you rather trade SCHG, which is about 200 growth stocks, and it's a $26 ETF? So I'm saying this like I don't want to buy it necessarily at $26, but $26 down to $21, I'm okay dollar cost averaging there, and that's a very cheap way to kind of trade the Nasdaq. I don't get the same type of option trading like I would in QQQ, but even if I said, okay, I like this area, I'm already long, by the way. We came to the 200, I'm already buying this. So I already have some shares right around current price. What I'm saying is if we come back and revisit the lows, I'm going to buy some more, right? If we have a high, low, lower, high, lower, low, lower, I mean, that's fine. I'll scoop up some more. I'll wait for maybe 20 to 30 50% might be like the generational opportunity, like back the truck up. I'm at 54% cash. I'm going to deploy most of that. If we're at 50% down on a lot of these indexes, if we get there, then yeah, I'm going to buy the crap out of this stuff. But this is a really cheap way to trade it. So that could be a good play moving forward. It's way cheaper than the QQQ. But if you like options like I do, I would probably do something along these lines. If we come back to these lows, it's pretty cheap for me to say, okay, I'll buy a call and I'll sell a put, and that's a synthetic. So this is my risk. I take the ownership right there. There is unlimited risk to the downside, but if I can, kind of time the bottom, it's like owning 100 shares. And it's far more cost effective that way than it would be just to buy the QQQ. So just options. Advanced decline line above the 50-day, watching this as well. If we get another opportunity, and this could certainly happen in 2025, if this market breadth indicator comes back down to lows, that to me is going to be my timing indicator to get long. So S5FI, NDFI, those are the Nasdaq, S&P above the 50-day moving average. Okay, stocks, currencies, Uber, got some good profit running on Uber. They have earnings next week. I did close up some profit on Uber. I don't know if I have any exposure left on it. My Uber is gone. So yeah, I closed out all shares. It was a ratio spreads. I think that's what I did on Uber. It's in here somewhere. I think I closed that last week, actually. I was up like 85 or 90% of max credit, so I went ahead and just took it. Uber. Look at the history here. Uber the last 30 days. There we go. So a little income trade of 98 bucks. And then over the last 120 days, some Uber, 600 bucks. So yeah, I mean, it was pretty good to me. One of many. All right, let's get currencies and I'll wrap it up here. Let me make sure I'm not going over on my calendar today. I'm good. Okay. All right, let me get some currencies really quickly. Today, Aussie on top, New Zealand on top, Swiss at baseline, Japanese yen. Not a ton of volatility, but decent. 70 and 80. Dollar certainly weaker. Some risk appetite coming out of China flows. So Aussie, New Zealand doing pretty well. Let's go Aussie CAD. I'm just going to power through these for probably about 5 minutes. Aussie CAD, I'm still long, holding long. Aussie Swiss, I'm still long, holding long. Aussie yen, if you're still holding long, it's same thing with New Zealand yen. If you had the courage to buy the August 5th bottom, small to kind of average into it, it's working out nicely. CAD yen was my favorite yen trade as far as the structure. Aussie New Zealand also looking better. I'm holding that one long. Aussie dollar, no trade. I know it's drifting higher, but even if the Aussie drifts higher, I think a pullback here, looking to kind of dollar cost average into this open space. If we get a pullback, this to me would make some sense, right? We go a little bit higher. Everyone that buys high gets a retracement, so they're going to lose out or they're going to be dealing with a drawdown. I like buying it in here, in here, in here. Be willing to take the swing trade. Just don't chase. I mean, if you're learning anything in currency trading, buying highs and selling lows of currencies is a terrible strategy. I never do it. Like I've passed on more trades because I'm not buying that. I'll wait for a dip. I'll wait for a pullback. I'll wait for a bull flag. Anything. Just don't buy highs. Don't sell lows. It's a terrible trade. Like FOREX is such a liquid market. It'll test a high, pullback. It'll go to a high, it'll pull back. Like there's always pullbacks in FOREX. CAD Swiss, still holding long, looking for a bottom. CAD yen, maybe this carves out a nice low. If we have this structure here, I still think there's some more upside. If it just breaks and goes higher, we could break here, pull back, still go higher. Again, this is all risk on type trading if the flows look pretty solid for that. Swiss yen, I'd stay out of that one. Euro Aussie, I'm not getting the pullback that I want. This just slides lower. I'm not selling lows. I'm not going to chase it. Euro CAD, I do like this trade. If you're selling Euro CAD, area 1, sell again at the highs. I think this trade still gets down to like 5,400. So there's still some room to go. If it pulls back a little bit, I like this area to sell Euro CAD. Euro Swiss, still holding long. Euro pound, nothing. Euro yen, nothing. Euro New Zealand, not really pulling back like I'd like. I wanted to sell it at that 50618 zone. If it just keeps sliding lower and lower and lower, I'm not going to sell the lows. But the best thing you could have done here would have been like basically taking a stab at these highs, and that's always difficult when the thing's up 1,000 pips. Euro dollar, I liked long euro dollar, but back here. I'm sorry, it's not long. I like short euro dollar back in here. If you're going to short this thing, area 1, area 2, even if it's a chop zone, if we go from this high to this low, I still think the euro dollar, we get a chance to like average into it. We can still hit like a 112 target or lower. I mean, this is a pretty clean fib from low to high. So pull back to like, 1050 makes a lot of sense. 1150 makes a lot of sense. If you're already short, that's fine. But I wouldn't have a tight stop loss. I'd say this area to then reselling the highs, I'd be, stopping out above those highs by about 1 ATR. Pound Aussie, again, breaking lower. I didn't get the pullback that I wanted. Pound CAD, I was trying to sell this one at the highs. I like Euro CAD better. Pound Swiss, it's okay. I think this pulling back to a pocket is a good spot. Averaging in area 2, if you're willing to kind of ride this out with small trade sizes, this is likely going to be my profit zone up in here in these pockets. So target 1, target 2 on pound Swiss. Pound yen, no trade. Pound New Zealand still, retesting, kind of noisy. Pound dollar, keep an eye on this one. This one might surprise us. I didn't like the pound dollar, but if we keep doing this could be an okay trade for a top to form and then a break back down on the right-hand side. But don't give it too much. I would say if you're selling highs, maybe 1 ATR higher for a stop loss, just don't put a stop loss immediately at a high. That's like the recipe for disaster for Forex trading because they'll poke those highs. New Zealand CAD still long. New Zealand Swiss still long. New Zealand yen, if you courageously bought that August 5th bottom, over here back in the April dip. New Zealand dollar, I'm still thinking we pull back a little bit more. Maybe just working our way back a little bit, just draw a fib from low to high, try to look at a zone in here to buy. And the nice thing is if this just breaks a trend line, open space trading to 63.70 is pretty good. Dollar CAD just kind of slowly drifting lower. Don't love it. Dollar Swiss, still going to hold my dollar Swiss longs into the 87.50 zone. And then dollar yen. If you're hanging on to this trade, this is a strong bottom. So maybe just a little chop and then higher and then chop and then higher. I think this probably gets into like the 148, 149 handle for now. So, all right. I'll wrap it up there. Happy Friday, everybody. Good stuff. Good trading. Have a great week. The heck was that? Oh, credit. Okay. Have a great weekend, and see you later. All right, bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the Edge Finder 40% off, our best discount of the year. Check out the links in the description below to visit the Edge Finder homepage or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.